Hey everyone, Mike Bowen, your loan officer over at Elevate Home Loans. So let's talk about 3 ways we can beat the market. So right now, what I saw a report the other day, it said home affordability has doubled in the last 30 years, meaning it's twice as hard as it was 30 years to afford a house. Then you look at Denver's market, which is on fire. That's just a national average, but Denver's market is on fire. It's become really difficult, particularly for first-time home buyers, but even move-up buyers, really hard market. So how do we beat it? How do we combat it? So I'm going to give you 3 things. Let's talk about temporary versus permanent buy downs. So here's what I'm talking about. You guys have probably all heard of like a 3-2-1 buy down, a 2-1 buy down. Let's talk about a 2-1 buy down. So what that really means, if the going rate is 7% today, if we do a 2-1 buy down, that means the first year we're at 5%. The second year we're at 6%, and then year 3 through 30, we are at the fully indexed 7% rate. All right. So here's some advantages to that, right? If you can get the seller to finance that, they get a little break coming in, and that's a nice break. 2% the first year, 1%, but ultimately they're going to end up at the same spot. So it's kind of a temporary fix. You can't qualify in terms of a mortgage, so it won't help them to qualify higher. You can't qualify at the bought down rate. So that's maybe the disadvantage. So it is just kind of a temporary, it feels good, and it can be a nice way to get people off the fence. The other part is a permanent buy down. Now, permanent buy downs are really being talked down right now because most people believe that rates are coming down. So why buy down a rate, right, temporarily, spend the money, and then in 6 to 12 months we refinance it? And that's true. I am one of the ones that is maybe advocating against doing the permanent buy downs. Here is the advantage, though. If you get someone that wants to qualify higher, to have the seller buy down the rate to give you 1, 2, or 3 points on the loan to buy the rate down from 7, say, to 6, well, that can make a huge difference in the payment. Literally, it could mean $50,000, $75,000 more in buying power, maybe more. So it can be a way they can buy down the rate permanently. Now they can qualify higher, thereby buying a little bit more homes. So that can be a great solution. The number 2 way that we can beat this market, use the equity from a previous home, not to buy down your mortgage, but to pay off your debt. So now what happens is $10,000 on a regular mortgage is $50 a month. If you put $10,000 extra, it'll save you $50 to $60 per month, which is nice. But if you spend $10,000 on debt, like credit card debt, it is likely going to save you in the hundreds, right? The minimum payment is going to be higher on a credit card and the interest rate is higher. So you get a bigger bang for your buck. Take the equity, pay down your debt, even if it means a lower down payment on the house, that's going to be a great win for the client. Number 3, one-time MI. So what we do is we do a buyer paid MI. They pay the premium up front. So let's say they're doing conventional, 5% down, they're going to have mortgage insurance. But we can do a one-time buy down where you pay the whole premium up front or the seller credits towards their closing costs. So essentially the seller is paying to buy that down. And now instead of a $200 or $300 mortgage insurance payment, they have 0 mortgage insurance payment. They essentially have no MI in the deal because it was prepaid up front. This can be a good deal for the same reasons I mentioned before. It will allow your buyer to qualify a little bit higher because their payment will actually be lower permanently. So these are some options to beat the market. I hope this is helpful. Have a great day.